Welcome to the Explainer. So, have you ever seen this happen? A company announces these amazing, record-breaking profits, and then its stock price actually drops? It's confusing, right? Well, today, we're going to get to the bottom of why that happens. We're going to figure out how to measure a company's real performance beyond just the headlines.
Yeah, it's a real puzzle, one you see all the time in the business world. Just imagine a big company, say a retail chain. They post these huge profits, everyone's celebrating, but what if they had to sink $1 billion into opening new stores just to get those profits? Did they actually create any real value for the people who invested in them, for their shareholders? That's the core question we need to answer.
Okay, so to really get our heads around this paradox, we've got to start with the metric that everybody looks at. I'm talking about the one you see plastered all over financial reports. Earnings per share. You know it, EPS. It's pretty much the default way people judge a company's performance.
And on the surface, EPS looks super straightforward. You just take the company's total profit and divide it by how many shares are out there. Boom! It tells you how much profit belongs to each little piece of the company. Seems simple enough, right?
And you can see why it's so popular. I mean, the calculation is set by accounting standards, so it's consistent. It's pretty easy for shareholders to understand. You don't need a finance degree. And the numbers are right there in the financial reports for everyone to see. It's become this quick, easy shorthand for checking a company's health. But, and this is the really important part, especially if you're studying for exams, EPS has some major hidden flaws. I mean, it can be seriously misleading. For one, studies have shown there's actually a pretty weak connection between a company's EPS going up and its actual value to shareholders. Plus, it can be, let's say, massaged by different accounting choices. This right here, this is the real kicker. It means you can't just take the EPS from two different companies and compare them, not even if they're in the exact same business. Why? Because how they're financed, how much debt they have versus how much money they got from shareholders, can totally warp the EPS number. It's not an apples-to-apples comparison at all. So that leaves us with a pretty big question, doesn't it? If EPS is this flawed, then what are we supposed to use? Is there a better way? How do we get an honest-to-goodness look at whether a company is actually creating wealth? Well, there is an answer, and it's a really powerful concept called economic value added. You'll see it as EVA. It was literally designed to cut through the noise and give us a much, much clearer picture of what's really happening inside a company. It was actually developed by a consulting firm, Stern, Stewart & Company, and their whole goal was to fix the fundamental problems that come from just looking at accounting profit. Okay, so here's the big idea, the key difference. EVA isn't just looking at the profit you see on an income statement. No, it measures something called economic profit. And what's that? It's the profit that's left over after you subtract the full cost of all the money, the capital that was used to make that profit. Let me put it this way. Everybody knows you have to pay interest on loans, on your debt, right? That's a cost. Well, your shareholders, the people who invested their own money, they expect a return too. That's a cost as well, the cost of equity. And the logic of EVA is simple. If your profits aren't big enough to cover both of those costs, you haven't actually created any new wealth. You're just treading water. All right, so that's the theory, but how do we actually calculate this thing? Let's break it down step by step, and you'll want to pay close attention here because getting the mechanics right is absolutely essential for nailing those exam questions. Okay, let's use some real numbers. We've got a case study here for a company division, Division X. You can see the key figures, their operating profit, how much capital is invested, the tax rate, and this thing called WACC. Now, WACC might sound complicated, but it's just the weighted average cost of capital. Think of it as the average return the company has to pay to everyone who gave it money, both lenders and shareholders. So this is the core formula you need to know. EVA equals NOPAT minus a capital charge. Now, NOPAT is just your net operating profit after tax. And that second part, the capital charge, that's what we were just talking about. It's the WACC multiplied by the capital invested. It's basically the dollar amount of profit that your investors are demanding as their return. We're going to do this in 3 easy steps. And seriously, if you're writing this out at an exam, follow this structure. It shows the examiner you know exactly what you're doing, and it's the best way to get all the marks. All right, step 1, calculate NOPAT. We look at our data and grab the operating profit, which is $7,500. Then we figure out the taxes. The tax rate is 30%, so 30% of $7,500 is $2,250.
Subtract that, and we're left with a NOPATE of 5,250. Easy.
Okay, step 2, the capital charge. Remember, this is what the investors expect to earn. We take the invested capital, that's 12,500, and we multiply it by our WACC, which is 8%. That gives us a capital charge of exactly 1,000.
And finally, step 3, put it all together. We take our NOPAT from step 1, which was 5,250, and we subtract the capital charge from step 2, which was 1,000. And there it is. The final EVA for Division X is 4,250. And because that number is positive, it tells us something really important. It means this division didn't just make a profit. It created real economic value for the company. Now, EVA is a fantastic tool, but it's not perfect. Nothing is. And for a really complete analysis, again, super important in an exam context, you have to acknowledge its drawbacks.
There are 2 main things to watch out for. First, EVA gives you an absolute dollar amount, right? Like our 4,250. That makes it really hard to compare companies of different sizes. You can't compare the EVA of a massive tech giant to a small local business. And second, it's all based on historical data. It tells you what happened last year, not what's going to happen next year.
Okay, let's wrap this up. To make sure all the most important bits are fresh in your mind, we're going to do a quick formula flash. This is your final recap of the stuff you absolutely have to know.
Here you go. First, the PE ratio, which is a useful tool to have when you're looking at that flawed EPS metric we talked about at the beginning. And then, the star of our show today, the complete EVA formula, NOPAT minus the capital charge. Definitely commit these 2 to memory.
So I'll leave you with a final thought to chew on. Imagine a company whose CEO gets a huge bonus for reporting a profit. But what if their EVA is consistently negative? That means they're actually destroying shareholder wealth year after year. Should that CEO still get a bonus? It's a question that really makes you think about how we define performance, how we measure value, and what we choose to reward.